Gary Whiting what needs to be said about David Mork that hasn't already been said. And by the way, he's the reason we started early today because he told me how long his presentation was going to be. Oh, no. Dave is Minnesota born and bred, received his BA degree from the University of Minnesota. He's been a Rotarian for almost 30 years. He's a multiple Paul Harris Fellow. He's married to the beautiful Sandy Mork, who somehow puts up with him. He'll tell us later.
47 years.
He's held numerous positions in Rotary, including president and district treasurer. Professionally, he is a CIRA, Certified Insolvency and Restructuring Advisor, rendering financial advisory services in the business turnaround and restructuring and bankruptcy practice areas. That is a mouthful. This requires both special knowledge and extensive relevant experience. As perhaps you didn't know, he plays pool and bears the title of Godfather, although I have absolutely no idea why. He spends 6 weeks or more each year in Mexico and apparently loves it. I think his picture is on the front page of the Sunriser. He comes today to enlighten us about the recent banking crisis in America.
Thank you. This Sunriser picture is interesting that Norman has put there. He said, I won't do anything nefarious for you, David. How about that? That's good. That picture is taken in Mexico. I was a young guy 5 or 6 years ago, and I wanted to enjoy the day, so I sat there on the beach and took photos of my feet. When you have that much time, you might as well relax. That was the thing. So I'm going to turn this on.
Foot fetish?
Sometimes only in Mexico. There are other shots, but I won't show you that. That was the first one. I guess I would like to ask, pay attention for a few minutes. I'm going to try and go through this. Whether or not you believe there was or is a banking crisis, and what's happened to your money, and what the banks have done with your money, I'm going to tell you. This has been my career. When I retired the first time in 1987, a year and a half later, I was working for the largest federal savings loan bank in the state of Minnesota, the largest failure in the state of Minnesota, in 1989. I retired again in 2006, and again a year and a half later in 2008, I get a phone call from the FDIC saying, we need you. So I can't retire again, guys, because I know a year and a half from now, I'm going to get called by the FDIC. So here we are. This is the banking crisis. What's happened to your money? I'm going to see if I can do this. Yes? I guess the first thing is, why me? And how did I get here to be in front of you? And this is a photo of my home in 1945, 46, and 47. This is the Bethany Children's Home, where I was a ward of the state for 2.5 years. So I became a punk kid. I was in a gang, kind of like, I didn't have an addiction, thank God, but I certainly was one of those kids that ran around and had some times. Then I decided I need to get smart. And I joined the military and became 3 years in the military and became an accountant for the military. Then I went to the University of Minnesota Duluth and got a degree in accounting. I was the only student that had triple minors that year in 1967. A major in accounting, a minor in BA of Bachelor's of Administration, another one in finance, and another one in political science. Then I spent my career working for these financial advisory firms, and I'm sure you recognize most of them. maybe not the one second from the bottom, Mork and Company Limited. A great company. We're the first bankruptcy firm in the state of Minnesota that had any bankruptcy and insolvency experience. In 1979, I started the Insolvency Association, which is now over 2,000 members. But I granted the Certified Insolvency and Restructuring Advisor designation. In 1982, when I had my own firm, I started the Insolvency Federation of the World, called Insol International. I'm the only living charter member. The other two guys from the UK and Canada have passed. But the times in the 80s were interesting. I then went to work at the Resolution Trust Corporation in 1990 after spending a year, and that's me on the left, by the way, after spending a year liquidating Midwest Federal Savings and Loan. How many of you remember that name? Okay, Midwest Federal Savings and Loan. Wikipedia would say it's the largest financial disaster in Minnesota history. It had assets of $3.5 billion, and today that would be around a $9 to $10 billion bank in today's dollars. It cost the government $1 billion to liquidate, and the reason I know that, and I didn't put that site up there, is but I'm the guy who went in 27 years ago this month and became the Vice President of Loan Review, which was, my job was to review every loan over $50,000 and give it a haircut or a reserve on behalf of the RTC. I did that, completed that by the end of the year. We put together the first ever bid package to sell the bank, the remaining assets that were already sold to Carl Pohlad at Marquette Bank, Minneapolis. But that was an interesting run, my start of the career. I then ended up with the Resolution Trust. The guy on the right is my boss then, Lewis Hunter. He just retired December 31st, 2015. And he's the guy that called me in 2008, said, "I want you back." I said, "Lewis, it's almost 20 years later." He said, "I want you back." And I said, "No, Lewis, I'm not going to do that. But if you know somebody who might need some assistance as a contractor, let me know." So it wasn't much longer, I got a phone call from RSN McGladrey up there and said, "I understand we're supposed to hire you." And that was in 2008, and that was First National Bank of Arizona. The largest failure in the state of Arizona, and the fourth largest failure in history of the failed banks. This is my work chart. This is a manual that I wrote on how to close a bank. And my friend and former boss, Lewis Hunter, redid this manual 3 times in the 20 years after I started it. And he reissued it in the meeting in 2008. And it became the 3rd iteration. And at that meeting in 2008 at the Adolphus Hotel, when the FDIC was looking for assistance, kind of a room like this, there was about 100 of us. Somebody in the dais at the FDIC said, "How many of you are former RTC?" And almost half of us raised our hands. So we basically came back, many of us, to assist the FDIC with our RTC experiences. And this manual was, again, the one that I used in closing banks. This is the photo of a corner office that I had when AmTrust failed in Cleveland, Ohio. I asked my wife, I said, "I have an assignment in Cleveland. Would you like to go to Cleveland?" And that's the response I got: "No, thanks." So 6 weeks in Cleveland later, I was done with AmTrust. This is kind of a history of what's happened in the banking crisis. 672 banks failed in the RTC days. 56 in the ensuing 13 years. And then in 2008 to 2015, 515 banks. When the crisis began in 1989, there was over 10,000 banks insured by the FDIC. And as you will see in the slide in a moment, there was something like $3 trillion. Today, there's over $10 trillion in those banks, but there's only 6,138 across the country. This is kind of a year-by-year, blow-by-blow slide. I don't ask you to look at that, but 515, that's a lot of banks, and I didn't get involved until 2008, and that 25, we were the fourth bank to fail at First National Bank of Arizona. And over the years, those are the institutions that I've been a part of and that I have liquidated. Typically, I'd go in as the president of the failed bank and take over the bank, and you'd have to go through me and the FDIC to get anything done. And basically, I had over 65 institutions, almost 10% of the failed banks in the country in the RTC days. In the last crisis, and again, I retired in 2006, guys, so I really kind of went back to work here in 2008 when I got the phone call. And since then, over that 5-year span, I've been a part of the failure of 43 institutions. And as you probably remember, it wasn't a fun day when you take over a bank, and I'm sure I mentioned that to a number of you. But I think you have to go back and look at the FDIC insurance in those days. And the FDIC would say in its 2015 annual report that never in the history of the FDIC since 1934 has a depositor ever lost any money. Never. So I guess you're safe. As long as you meet the insurance limits. And I remember some years ago I brought that up to a few people here to the club. And several of you came back to me later and said, "Thank you, David. I did not know that I had over $250,000 in those banks where in Iowa and other states." So I think that makes sense. And the $250,000 is still a lot of money. The interesting thing on this slide is they only closed 8 banks in 2015. And in 2016 through today, we've only closed 1. I say we because I'm a student of this process and I understand this process and I've been part of the process for so many years. But you can see we have 6,182 banks insured by the FDIC at the end of the year. That's a far cry from 13,000 back in 1989. And of course you can see the employees have gone down too. And that makes sense. But look at the number of assets, the amounts of assets, $10 trillion. How many of banks control? 81%. I'm sorry, 81, I can here. 81%. 111 banks out of the 6,182. 111 banks control $8 trillion. What do the other 6,000 do? How can you make any money? Last week they closed a bank in Raleigh, North Carolina. $61 million in assets. The average return across the land for 6,182 banks is 0.0066. In other words, 0.6% return on assets. Is that a fair number, Wolf? Yeah? That's just about what? $400,000? No wonder it failed. Who can make any money on the $61 million bank? And that's the problem across the land with these community banks and these small banks under 100 million. They really need to be fixed. On the other hand, we've had 450,000 ATMs across the USA. 3 million worldwide. So let me ask you, what do you think has changed in your banking world? Nothing. As far as you and I as consumers. We get to go to the bank, we deposit our money, we write a check, pay a bill, and move on. Now today we use a mobile phone, we use our iPad, we use an ATM. Do you need to go to the bank? No. Do you need to talk to the banker? No, you can call him on the phone. It's no longer the 363 rule. Remember that, Walt? 363. You come into my bank, and I say, thank you very much, and I will pay you 3% on the money that you give to me. Then I'll turn around and loan it to the next guy, gal, at 6%. I get a 3% spread, and I'll be on the golf course by 3 o'clock. That's the 363 rule. So let me say, who controls the money? Well, we had 10,000 banks in 1989, and then comes this Regal-Neal Interstate Banking and Branching Efficiency Act of 1994. Just as I moved to Arizona, I was banking with Northwest Bank Minneapolis, and I moved down here and I opened up with Northwest Bank Arizona, thinking they're close to the same bank. No. They're wholly owned subsidiaries of the main holding company, but they don't talk to each other. That fall, this act was passed. The 10,000 banks continued to reduce, basically because of this. If there was one bank, Northwest Bank Minneapolis, it had offices in 15 states, it had 15 banks. It became one bank. So it's somewhat misleading that there wasn't really a 44% reduction, just that this act helped. Another statistic, 5 banks control over 44% of the deposits. Wells, Citibank, Chase. What do you think was the root cause? And as I always say in pool, what's the reason pool declined? Well, it was marriage. But that's another story for another day. Well, what was the root cause of the crisis? Bank investors, everybody had agreed. Michael Douglas, in his film Gecko, was that his name? Wall Street. That's so true. Wall Street investor greed in the last crisis, no question. If you haven't seen the movie The Big Short or read the book, I urge you to. Gullible consumers. People have strange ideas. And in 1989 and prior, and this is where this comes in, this gullible consumer reporting on fraud, what happens is, back in the day, these country banks, most of my work was in South Texas, with the Resolution Trust. And the banks that I saw fail there were basically a table like this. 6, 8 guys sitting around a table. Each of them put up $100,000, $200,000 of money. They went into the local savings and loan, which was just a little country bank in the middle of nowhere, put their deposits in, and then asked the president to call a board meeting and a shareholder, or a mutual what you call a shareholder meeting. Because as shareholders, you were depositors. Depositors get a right to vote based on their volume and their accounts. Nobody ever attended these meetings except that group. I call them thieves. They came in, took control of that thrift, moved the money around, loaned it to other friends, countrymen. Good projects originally. Phase 1, Phase 2, Phase 3. Phase 1 was wonderful. Phase 2 couldn't go. The bank failed. This happened across the land. So, who's more gullible? Well, the FDIC then didn't have the people to understand what was going on and how that happened across the land. Skip forward 2008, the FDIC did not have the people. When you saw that slide, 11,000 FDIC folks in 2008, that's because they ramped it up. Their examination division was basically obliterated. So they couldn't get the people in there fast enough. Because of that, they couldn't get in to look at the banks. And they didn't do what we did back in the 80s. And in fact, audit the bank and look at everything everywhere. They did standardized testings. They did random access testings. And the regulators were not strong enough, and there was a huge, huge lobbying division against this regulation. And this is so true, and even the chairman of the FDIC will echo these words. And I think there's another shortage of underwriting policy and lack of review. And finally, of course, back in the 80s, was interest rate rise. Most of the SNLs in those days, when I look at Walt, look at that, had fixed mortgages, and they had to start paying more money for their deposits. And when deposit becomes greater than interest income, we're in trouble. And the banks failed. In 2015, 8 institutions failed, and that was one huge bank in Puerto Rico. $6 billion. It cost the FDIC insurance fund $749 million. So the other 7 didn't cost it a lot of money. The other 7 were $1.6 billion. So I'm going to ask, do you think they're too big to fail? No, absolutely not. Why? Each bank across the country, over $50 billion, has passed a stress test. In 2014, I prepared FDIC's response to the stress test on a $50 billion bank as to what we would do and how we would fail the bank. It took me 6 weeks, and I had a staff of about 65 people on the organization chart. So the FDIC knows how to handle these banks. And that was first discussed by Timothy Geithner in 2008. When the FDIC first created the RTC in 1989, they funded it with $125 billion. Was they thought that should cover it. Now, it's 2008. I want you to see something. There are 9, just scroll up. This is Goldman Sachs. They got 10 billion. Morgan Stanley. This is the weekend, October the 13th, 2008. Who knows what that day is? It's Columbus Day, 2008. It's the day that Timothy Geithner, Hank Paulson, then Secretary of the Treasury, were sitting on Sunday meeting with the presidents of these banks, Citigroup, Chase. You'll see Jamie Dimon's signature. This is Kovacevic from Wells Fargo. These are the actual pieces of paper. Jamie Dimon's signature. $25 billion in the TARP program. State Street, Bank of America, $15 billion, just a piker. This is the money that was given on that weekend in 2008 by Timothy Geithner and Hank Paulson. I just told you in 1989, Congress gave FDIC $125 billion. These 9 companies, these 9, got $125 billion and counted as capital. Because if they didn't do that, the banking crisis that we were faced with in 2008, we'd all be talking different tunes. We would all be talking what happened and why didn't they save us. The folks from Lehman Brothers are noticeably absent from this. They failed that weekend. Goldman Sachs, by the way, Hank Paulson, Treasury Secretary, was the former CEO of Goldman Sachs. Goldman Sachs became a bank. Why? Because the assets that they had, your assets, you wanted cash to get out of this crumbling institutional drop in your values and your portfolios. Goldman had no money. Virtually, they were running out of money. So what did the FDIC do? They made them a bank, and they said, okay, every one of your REITs, every one of your assets across the country. This is the same for Wells Fargo, this is the same for Citibank, this is the same for B of A. Every one of your assets, I pledge that I will loan you 100% of book value, not market. Because there was no way they could get market. They didn't know what the market was. How do you sell your 51% interest in the Empire State Building overnight? You can't. So they became a bank and all those assets were pledged. And they could take those assets, give it to the window of the FDIC, and get their money. No runs. Nobody failed. These 9 did not fail. They got the money. $125 billion. What I think is amazing is judicialwatch.org found this and published it as a PDF. I found it as a footnote to Timothy Geithner's book. So now we have the Dodd-Frank Act, providing regulations, and I think huge overviews. And a threat, like Charles Keating did in 1992, 93, now closer to 89, 90, when he filed bankruptcy, American Continental. He was being placed into the conservatorship by the FDIC, and he turned around and filed bankruptcy petitions for every one of his subsidiaries in the entire bank. My firm was the only firm that didn't have a conflict, and I came here to Phoenix to work on those subsidiaries back in the day. So resolution's going to happen, but if there's small banks like this, I don't see a problem. The big banks, that's not going to happen. So, will there be another? I don't know if we learned from history. Here I am 20 years later in a room with the FDIC all over again. It's like deja vu all over again. The crisis is here. The regulators are asleep at the wheel. Well, the greed is rampant. The thieves from the 1990s moved on to Wall Street and decided to bring up new products because they were looking for new ways to give you money and make more money. Tranches. Who ever heard of a tranche other than a trench? My dad would say, dig a trench. Well, now they're talking about tranches. There are 3, 4, 5, 6 of these things when you have these pools of money. In the 80s, most of these savings and loans held their mortgages. Virtually all of them did. They didn't sell them. Maybe a little bit, but it really wasn't like you see today, mortgage-backed securities. This is Wall Street's invention. My question to you is, what is Wall Street going to look for next? I don't know. But we know that history has said we're probably going to repeat some of these mistakes. I just saw yesterday 0% interest. How can you make any money at 0% interest? Who can do that? So thanks for listening. And there we are.
Any questions?
Hey, Frank.
David, buddy, about, okay, but you closed numerous banks down in the Phoenix metro area. What was that process? Explain what you did exactly.
I was telling this to the banker from Mr. Phillips, right?
Yes.
Very good. From Portland. The process hasn't changed in 20 years. But basically, when I wrote the manual in 1989, 1990, I basically said, here's what we do. We assemble the teams of people. You handle deposits, you handle loans, you handle HELOCs, you handle auto loans, you handle ops, you handle the computer stuff, you handle the safe deposit boxes, and you ride with me. And we have these teams of people. And we walk in and nobody knows at the bank that we're coming. And at 5 o'clock, we go in and close the bank. Lock the door, nobody leaves, there's the guards. We've hired the guards already. We have a meeting with all the people, and we tell them to come back tomorrow. And we control the bank. Nobody gets in, nobody gets out unless they go through us. All the computers are cut off. All the email systems are down. All the websites are down. There's no access to the bank's records. You walk into an institution and you'll see somebody at their computer, hands up. Now. And then, if you get any grief, out the door. You're done. So, at that point, we take over the bank and then we start understanding what happened and where all this consists of. What all this consists of. And eventually we'll bring it up to Wall Street. Yes. We'll package these loans. We'll sell these deposits. We'll sell these branches. We'll sell these safety deposit boxes. We'll pay off the deposits if nobody buys us. So it's a process, and it happens across the country every day, every Friday. The FDIC will close a bank. They always close on Fridays. I've only seen less than 3 or 4 where they close it during the middle of the week. So they get the weekend. The press release is already done. When we closed the bank up in Scottsdale, I sat at the back of the room, like this. There was 150 folks from the FDIC, the bank, regulators. None of the people from the bank were there. They had no idea. We were at the Fairmont up in Scottsdale. Nobody knew. We had to close the mortgage company. We had to close the bank. We had to take down all the branches. We had people en route to the branches, and at 5 o'clock we shut it down. And the guards show up. And at that point, it's ours. When they ink that on the conference call with the comptroller of the currency, and they appoint the FDIC as receiver, by the stroke of a pen, the FDIC is receiver. And that's the power the FDIC has. That was granted, by the way, under what they call FIRREA, FIRREA, which is a piece of legislation that gives the FDIC awesome powers. Is that right? You guys in the banking world? Awesome powers. They don't like it, I renounce thee, I renounce thee, I renounce thee. That's over. The FDIC says so. So that's what happens. It takes about 100 days. 150 days. We got to be out of there in 180. And 7 years later, 2015, July, that receivership is what was created in 2008. Must, by legislation, must close. Zero. So there's 408 active receiverships out there right now, and that's because there was 515 closed in the last 7 years. So as they go through the process, accumulate the money, sell these assets, pay off the creditors, pay off the FDIC, 7 years from the date of failure, it must close. So it can't continue. And we do that across the land, whether it's a big bank or a small bank. Hold on.
How about,
One more?
no time for questions. Hopefully David can stay after the meeting to answer questions, okay? Fred and others?
One thing you neglected to talk about